What if I told you the largest financial disaster since the Great Depression was not caused by reckless homeowners or greedy bankers, but by a system that was carefully engineered over decades to look safe while quietly becoming more unstable? The 2008 housing crisis was not a sudden collapse. It was the predictable outcome of how the United States structured money, housing, and credit after World War II. To understand why the system broke, you have to understand why housing became the center of the American economy. After the Great Depression, the United States was terrified of another economic collapse. Mass unemployment, bank failures, and homelessness had nearly destroyed the country. Policymakers concluded that stable families owning stable homes were the foundation of economic and political order. Home ownership was no longer just a personal goal. It became a national policy. In 1938, the government created Fannie Mae to stabilize mortgage lending. Banks made loans, Fannie Mae bought them, then Fannie Mae packaged them into bonds and sold them to investors. This created a national mortgage market. A bank in Ohio could sell a mortgage to an investor in California. Money could flow freely into housing. In 1970, Freddie Mac was created to expand this system. The two agencies became enormous buyers of mortgages, providing liquidity to the entire housing sector. This changed how banks operated. Before this, a bank could only make loans equal to the cash it held. After this, it could make loans, sell them, and immediately get its money back to make more loans. This dramatically expanded credit. But it also created something dangerous. The bank that made the loan no longer carried the risk. That risk was passed to investors. For decades, this worked because lending standards were strict. Borrowers had to document income. They needed down payments. Loans were conservative. That discipline disappeared in the late 20th century. In the 1980s and 1990s, Wall Street discovered that mortgage bonds were incredibly profitable. Pension funds, insurance companies, and foreign governments wanted safe assets that paid more than government bonds. Mortgage-backed securities filled that role. Investment banks began creating private mortgage bonds, buying loans from lenders and packaging them for global sale. This created an enormous incentive to generate mortgages. The more loans Wall Street could buy, the more securities it could sell. By the late 1990s, housing finance had become one of the largest financial markets in the world. Then the Federal Reserve poured gasoline on the fire. After the dot-com crash and the September 11th attacks, the Fed slashed interest rates. Money became cheaper than at any time in modern history. Borrowing exploded. This caused housing prices to surge. When prices rise, people behave differently. They stop seeing risk. They start chasing returns. Americans began treating homes as financial assets. They refinanced repeatedly. They borrowed against their rising equity. They spent the money. Wall Street realized something dangerous. If housing prices always went up, then mortgages were not risky. They were guaranteed, so lending standards collapsed. Banks began offering mortgages to anyone who could sign their name. No income verification, no assets, no down payment. Some borrowers did not even know what their payments would become. These were adjustable rate mortgages. They started cheap, then exploded. Millions of people were being set up to fail. The lenders did not care. They sold the loans immediately. Wall Street took these loans and bundled them into mortgage-backed securities. Then they sliced them into tranches. The top tranches got paid first. They were labeled AAA. The bottom tranches absorbed losses. The math said this was safe, but the math was built on false assumptions. The models assumed housing prices would not fall nationally. They assumed defaults in different regions were independent. Neither was true. Rating agencies approved these structures because they were paid by the banks. By 2006, the global financial system was sitting on trillions of dollars of mortgage bonds that only worked if housing prices never fell. The bubble was now too big to fail, and too big to survive. While the housing bubble was expanding across the country, something even more dangerous was happening inside the financial system. Banks were no longer just lending money. They were manufacturing risk. By the early 2000s, mortgage-backed securities had become one of the most profitable products on Wall Street. Pension funds, insurance companies, and foreign governments all wanted them. They paid more than government bonds but were still considered safe. Investment banks realized they could create as many of these securities as there were mortgages to bundle, so they pressured lenders to produce more loans. The quality of the borrower no longer mattered. Only the quantity of loans did. Lenders were paid when a mortgage was issued. Wall Street was paid when the mortgage was sold. Ratings agencies were paid when the security was rated. No one in the chain was punished when the loan failed. The entire system became a machine for producing debt. Mortgage-backed securities were only the beginning. Wall Street soon realized it could multiply profits by reshaping risk. They created collateralized debt obligations, known as CDOs. These were securities built out of the worst parts of mortgage bonds. The risky tranches that could not be sold easily were bundled together into new bonds. Then those bonds were sliced into tranches again. Magically, risky debt became safe debt on paper. The rating agencies blessed this transformation. They used statistical models that assumed housing prices would not fall across the entire country. They assumed defaults were independent. They assumed diversification eliminated risk. Those assumptions were wrong, but they produced AAA ratings. Trillions of dollars of fake safety flooded the global financial system. Banks used leverage to amplify profits. Some were borrowing $30 for every dollar they owned. A small decline in asset prices could wipe them out. This is where Michael Burry entered the story. Burry was a hedge fund manager and former doctor who believed markets were driven by data, not narratives. While everyone else trusted ratings, Burry read the actual mortgage contracts. He saw loans that required no income. He saw adjustable rates that would reset in 2007 and 2008. He saw borrowers who would not be able to pay. He calculated what would happen when those resets hit. Defaults would spike, foreclosures would rise, mortgage bonds would collapse. Burry needed a way to bet against the system. That instrument existed, but almost no one was using it correctly. It was called a credit default swap. A credit default swap is a contract that functions like insurance. If a bond fails, the seller of the swap must pay the buyer. The buyer pays a small premium. Wall Street believed mortgage bonds were safe, so they sold this insurance cheaply. Burry realized that he could use swaps to short the housing market. He contacted major banks and asked them to create credit default swaps on mortgage-backed securities. They were confused. Why would anyone want to bet against housing? But they sold him the protection. They collected fees and believed the risk was impossible. Burry began building massive positions. His fund lost money as housing prices continued rising. His investors panicked. They demanded their money back. Burry locked their capital in place. He knew the timing mattered. The loans would not fail until the teaser rates reset. As 2006 turned into 2007, the first wave of resets hit. Monthly payments doubled. Borrowers defaulted. Foreclosures surged. Mortgage bonds began collapsing. The insurance Burry bought suddenly became incredibly valuable. But Burry was not alone anymore. Goldman Sachs and other banks began to see the same data. They noticed rising defaults. They kept selling mortgage securities to clients. But internally, they began buying credit default swaps. They were hedging their own products. They were betting against what they were selling. This was legal and incredibly profitable. Meanwhile, AIG, the world's largest insurance company, had sold enormous amounts of credit default swaps. They believed housing could not fall nationwide. They did not set aside money to pay if it did. They were wrong. By 2008, AIG owed hundreds of billions of dollars. If it failed, the entire financial system would collapse. The government had to step in. Banks, insurers, hedge funds, and pension funds were all tied together by derivatives. The system was not just fragile, it was wired to explode. By 2007, the cracks in the housing market were no longer hidden. Home prices stopped rising. That alone was enough to break the system. Millions of homeowners had loans that only worked if prices went up. They were refinancing constantly. They were borrowing against their homes to make payments. Once prices stalled, that stopped. Defaults began rising. Foreclosures followed. Mortgage-backed securities began losing value. The problem was that no one knew how much anything was worth. These securities were traded in private markets. There were no transparent prices. Banks marked them at whatever value they wanted, but behind the scenes everyone knew something was wrong. In 2008, Bear Stearns collapsed. It had been heavily invested in mortgage securities. The Federal Reserve arranged a rescue to prevent panic. That panic came anyway. Lehman Brothers failed in September 2008. It had massive exposure to housing and derivatives. When it collapsed, the global financial system froze. Banks stopped lending to each other. No one trusted anyone. AIG was next. The insurance company had sold hundreds of billions of dollars of credit default swaps it could not pay. If AIG failed, every major bank in the world would take catastrophic losses. The government bailed it out. Trillions of dollars were injected into the financial system. Banks were saved. Homeowners were not. Millions lost their homes. Millions lost their jobs. Michael Burry's trades paid off. Scion Capital made about $2.7 billion for its investors. Burry himself earned over $100 million in fees. But the world lost trillions. Goldman Sachs and other banks survived because they had hedged. They had bet against their own products. No one went to prison. The system was too complex to assign blame, and it still exists. Banks still securitize debt. Ratings agencies still get paid by issuers. Derivatives still hide risk. The machine was patched, not replaced. Michael Burry did not see the future, he saw the structure. That is information arbitrage. Outthink the crowd.